Good morning, everybody. Hey, it is, what is it? Saturday, May the 23rd, and this is a live broadcast to Dream for All winners. So thank you. And first of all, congratulations. Congratulations for being a winner. Congratulations for sticking it out. I know that it took longer than anybody expected in order to get the results, but we are here. You are a winner, and now the stress kind of begins because now you have a time bomb sitting in your hand right now. You have a voucher, and you're trying to figure out, how do I best use this, and how do I play this to my advantage given all of the variables that are happening right now. And so I'm going to help guide you through all of those things, help really give you all of the information that you need. So my goal today is to make this as interactive as possible. If you have questions about anything, post it into chat. If you're watching live, I'm going to pull it up on the screen and I'm going to answer your questions right away. If you're watching recorded, then I'm going to come back later and I'll catch your comments later. So right now, I want you, first of all, to think of any questions you have, post them into chat immediately. Don't be shy. But let's go ahead and kick it off and talk about the things that I want to talk about. So first of all, congratulations on getting selected for the voucher and for being a voucher winner. This timing is going to be the biggest thing for you as far as using your voucher, how you use it, when you use it, and market conditions. And so I'm gonna kind of pause from my presentation for a minute and simply say, look, there are a lot of factors that are going on here that are going to be outside of your control. You cannot control house prices. You cannot control interest rates. You can't control availability of homes. Yet you have a short amount of time to get an offer accepted on a home. Now, I don't want you to feel like I'm pressuring you to rush, but I also don't want you making the mistake that some of my clients made back in 2024, which is that they thought, oh, I've got 3 months to buy a home, or I heard that, you get an extension, which you should be able to get an extension for an extra 90 days. So you actually probably have 6 months. I say probably because Cal HAFA has never put in writing that they're going to give extensions. But I expect you're going to have 6 months to find a home. And so you might have a friend say, the best time to buy a home is in the winter because there aren't as many people shopping for homes. And so you should wait until the winter to buy a home. And I had a client who did that back in 2024, and she missed out on using her voucher. She waited until she was about 4.5 months into the process into the timeline of when she had her voucher. She had 1.5 months left to use her voucher. And that's when she started shopping in earnest. And she couldn't get an offer accepted. She lost her voucher because she waited thinking she'd get a better deal in the wintertime. There wasn't enough inventory out there for the area that she was looking at, for the homes that she wanted, in the price range that she was approved for. And she missed out because she was told timing the market would be better in the winter. I also have other clients who have said, oh, I don't want to buy yet. I had a couple people tell me right now, John, it's a bad time for me to buy because interest rates have gone up again. And we don't want to buy with a higher rate than what we have to have. And so we should wait and not use our voucher right away. That's a choice, but that choice is a very big risk because interest rates are something you can't control. When you're refinancing, you have a little bit more flexibility on when you pull the trigger on a refi. When you're purchasing a home, you're just plain purchasing a home. Now, Dream for All adds an extra piece that you have a deadline of when you have to be in escrow in order to use this money. So a normal buyer in a normal lending situation can say, hey, I think the market's just bad and I'm going to wait a year to buy a home. You can do that, but now you're guessing on the timing of the market. You're guessing on, hey, is this a good time to buy or is this not a good time to buy? And I've got I actually did my live stream yesterday. My market update was all about, so if you're watching this later, go back to the live stream on March 21st. No, wait, what's today's 25th, right? 23rd. So yesterday's 22nd. All right. So need these, I'm getting old. So if you go back to March 22nd, yesterday, you'll see my live stream was all about market cycles. And the fact that the cycle in 1990, where prices hit a high and they started dropping, 2007, prices hit a high and started dropping, 2017, prices hit a high and started dropping, 2022, prices hit a high and are still dropping. Yet each of those cycles, the recovery happened within 3 to 6 years. And we're right now 3.5 years into this cycle. So we have anywhere from 0 to 3 years. And by the way, the only one that took 6 years was the Great Recession in 2007. So you got to look at the market conditions. And as soon as interest rates start falling again, we're going to see house prices take off. Now, that's a good thing when you're a homeowner because you have the equity that you are building once you've locked in that low price, and you can refinance at a lower interest rate. I have a client going through a refinance of a Dream for All loan right now. She was one of my most expensive locked rates. She got a voucher, and rates when she got the voucher were around between 6.5 and 6.75. But they spiked. By the way, that's where they are right now, is 6.5 to 6.75. They spiked right when she got her offer accepted to 7%. She said, I'm going to wait. So we waited, it went to 7.1. She said, I'm going to wait. So we waited, it went to 7.25. She said, I'm going to wait. We waited, it went to 7.375. She at that point, she did not qualify if it went any higher. And so she locked it in. 3 days later, it started falling again. You never know. You can't time the market. So she's got a rate at 7.375. We're refinancing her right now, and I got her locked in at 6% a couple weeks ago. So she's getting a huge amount of savings off of her monthly payments because she's executing that refinance at 6%. But remember, you only get to refinance once with your Dream for All loan. So there's a lot of factors going on here, but don't get caught up in the timing thing where, hey, I want to time the markets. I want to time interest rates. I want to time home values. Time is not on your side. And don't wait too long thinking things will look better down the road. Okay. All right. So let's dive into the meat of what I want to talk to you guys about. And let's go over your next steps. So what we're going to cover, we're going to cover education. You need to start working on education now. You need to get a real pre-approval letter. I'm going to explain what that means. You need to pick your realtor. We're going to talk about types of homes. We're going to talk about new construction. We're going to talk about the 3 ways to use the money. And I'm going to remind you to use my app. We're going to talk about what money do you need out of pocket? What if I don't find a home in time? And what if I find problems in the inspections? And then finally, can I buy a foreclosure or a short sale? And all along, you'll have the opportunity to ask questions. So at any point you have questions, post them into chat. I'll pull them up and talk to you about them as we go. All right. So first and foremost, education. Get your education done now. You have a voucher. You have a voucher. Now, if you're watching this and maybe you're on the wait list and you're saying, well, I just want to watch it because I want to learn what I need to know when I have a voucher, don't do your education because we don't know when you're going to get a voucher. But if you have a voucher, your voucher is good for, your education is good for 1 year. Your voucher is good for 90 days and it should be extended another 90. So it should be for 6 months. So that means you're going to buy the home before the education expires in a year. So go do your education. There are 2 types. There's the CalHFA Dream for All education, and there is general home buyer education. And where you need to go is you need to go to CalHFA's website. Man, I'm getting old. I need to keep putting these on. All right. So you need to go right here. You need to go to CalHFA's website. So calhfa.ca.gov. You all should know how to get there. And you're going to go right here under Dream for All. And then once you get to Dream for All, right here, you're going to see where it says Home Buyer Education. And you're going to click on Home Buyer Education. It scrolls you down on the screen. So right here, the Home Buyer Education, there are 2 types of education. You've got the first type that is an or. So online or in-person virtual. Do the online one. Do the top one. It's way easier. I have no complaints about it from clients. Do the top one. So go to eHome, sign up on this one. It's a $100 fee. You're fine. Go for this one. Okay. You can technically do one of the other ones, but sometimes you end up picking the wrong one and it doesn't apply and it's just a nightmare. Sometimes they're more expensive. Do you really want to go sit for 8 hours in a location in person? Like, do the online one. So this first part is an or, online or in person. Then there's an and right here. And so one of these 2 and the California Dream for All Shared Appreciation Education. So this is the and. You need to do the Dream for All education. It's easy. It's 30 minutes. It's just explaining to you how you share a portion of your equity, which you should know already. I've done 100 videos on it. If you have questions about it, ask me, but it's not free money. You're always going to pay it back. You're going to pay it back with 20% of your appreciation. So you can pay back what they loaned you plus 20% of whatever your home value has gone up. You get to keep the other 80%. Now, if you happen to buy a more expensive home, if you buy $1 million home and you're saying, hey, John, why do I have to pay back 20% of $1 million home because their $150,000 was only 15% of the $1 million home. You actually only pay back the 15%. You pay back a proportionate amount relative to what you borrowed. So if you borrowed 150 grand on $1 million home, you got 15% from the state. You pay back the state the 150 grand plus 15% of your appreciation. Okay. All right. So that's the first thing. Get your education done and get it done soon. All right. What's next? You need to get a real pre-approval letter. You got a letter from me or from another lender, but you got a letter that gave you the ability to get into the lottery. It said you are pre-approved, but it is not a full pre-approval letter. We did a shortened version of the process. We basically looked at just your income, sometimes a light version of your income. We didn't look at your assets at all, and we have to, even if you're not using any assets. We didn't dig into your employment history as far as we normally should. So we've got to get more information now. The letter you got before is not a letter that you can use to give to a realtor to submit with an offer. Okay. What you need to get is a full pre-approval letter, which means we've got to get updated documentation. Now, for those of you, and I have a slide on this later, but I want to point it out now. For those of you who worked with me to get your pre-approval letter, I have spent the last 15 years working for Summit Funding. Well, in March, Summit Funding merged with Cross Country Mortgage. So Summit Funding doesn't exist anymore. I am now part of Cross Country Mortgage. I have all of your paperwork from before, but I need to update it anyway. So I've got your W-2s and your driver's license if you gave me the driver's license, but your pay stubs don't matter anymore because your pay stubs are 2 months or more old. We're going to pull a new soft credit report at this point in time, and we may decide to pull a hard credit report. So we didn't pull hard credit reports on anybody previously. We have to have a hard credit report in the file that is less than 4 months old on the day you get your keys. So if we start right now with soft credit and you get into escrow in a month, I'm going to pull hard credit right then. The soft credit score today doesn't matter. The soft credit score from 3 months ago doesn't matter. It's the hard credit score that matters. You have to have a 680 credit score or above. If you're low income, you can be at 660. And over 700, and you get more relaxed guidelines when it comes to how much of your income we can spend towards your bills. In other words, you'd qualify for a higher purchase price and a higher monthly payments. But that credit score is not locked in until we get hard credit. Well, what if your credit score was 640 and you finally got it up to 700 and you fought really hard to get it there? Then I'd say we pull the hard credit right now because then it locks it in and we don't have to worry if it slips to 699. So that's the strategy conversation that I'm going to have with you to help you decide, do we do soft credit or hard credit right now? But we're going to update your credit. We're going to update your income and your assets. And then we're going to give you a pre-approval letter. Then we're going to go one step further. We're going to submit your file to our underwriting team to get what's called a fully underwritten pre-approval. That allows your realtor to check a different box on the purchase contract. That box says to the seller, hey, it isn't just the loan officer that says that I'm fine. By the way, I'm a really good loan officer. But the industry has some not so good loan officers. And so realtors have realized, hey, not all loan officers are treated the same, and they're not the decision maker, the underwriter is. And so there's a checkbox that says pre-qualified, that's bad. Pre-approved, that's good. Fully underwritten pre-approval, that's great. That makes you stronger in the eyes of the seller. And it's really, really critical that we make you look as good as possible to the seller. Because now our strategy is finding you the right home at the right price and getting your offer accepted. And the key in any market is how do you create a win-win situation for you and the seller? And that's where I partner with you and your realtor. And I'll talk about that in a minute. So we need to update your paperwork. We need to update your credit report, and then we'll give you a pre-approval letter. Then we'll get it submitted into underwriting and get a fully underwritten pre-approval letter just so that we are that much further along in the process. It's a smoother process from here forward because it's going to be a faster process since it's been fully underwritten, and you look stronger in the eyes of the seller. Now, I want to talk for a minute about income limits. And in general, let me say this. Everything about your qualification is locked in at the time that you are under contract. So if your credit score drops, we didn't have a credit report, or if your pay changes, we're going to update all of that stuff at the time that you are under contract. And so you're saying, some people have said, oh, John, I had a 680 credit score back when I got my Dream for All pre-approval, so I'm fine. No, like we have to have the credit score now. Or, hey, John, I made the right amount of income. I was under the income limits back when I got my Dream for All pre-approval, so I'm fine. No, if you got a pay raise since then and that puts you over the limits, we're in trouble. Now, the income limits are changing. They change every single year in June. CalHFA publishes their changes anytime from early to late June. The way the process works is the federal government puts out income statistics in April. Well, it got delayed this year. They didn't put it out until May. So then Fannie Mae puts out their numbers in May. Well, that's not out yet because the federal government delayed their initial numbers. Then CalHFA runs their numbers and puts their numbers out in June. So I think it's going to be late June, maybe even early July, because the trickle effect of the fact that the federal government didn't put out their numbers until a month later compared to when they normally put out the numbers. What does that all mean? That at the moment that those numbers change, there is a little bit of a, how do I want to say this? A gray area, because it depends on when I ran your numbers through the system as to whether you're locked in before or after the income limit change. Now, usually I can kind of start over if the new income limits help you, but I can't backdate something. And so there's a lot of strategy here that if you're really up close to the income limit and we're worried, or maybe you just got over the income limit, then we want to wait. I don't want to lock you into the old limits. But if you're just under it right now, maybe I do want to lock you into the old limits. There's a lot of strategies there that are going to be more one-on-one conversations between you and I. All right, I got a comment or a question. Kevin just saying hi. Good afternoon from Lakeland, Florida. Good afternoon, Kevin. All right, so you need to get a pre-approval letter. Income limits are changing. No matter who you got pre-approved with, everything needs to be updated now. All right, so now is the time to pick a realtor. So let me be clear. Your realtor helps you find the home. I help you get the money, okay? So the money for Dream for All, I know it's not applicable to this slide, but the fact is the money for Dream for All, it's important for me to talk about this. I'm actually gonna move off of here and say, one of the things that is very misleading is people misunderstand. Dream for All is not just the 20% down payment. Dream for All is both loans. The state requires to get our extra 20%, you have to take the big part, the 80%, from us as well. So the state of California determines the interest rate every single day on that money. Now, the interest rates are market, okay? But what's the definition of market? It's like somebody telling you, hey, gas prices, we charge market gas prices. You could drive to 100 gas stations. There is no one price for gas in every gas station, but they're all really close to each other. They're similar in price from one gas station to another. And if everybody is between $5.50 and $6 a gallon, nobody's at $3. Same concept with interest rates. And CalHFA is not high compared to the market. There's some banks that are lower, but you can't choose. Even if you switch from one lender to another, even if you said, John, I'm leaving you because I got a bank telling me they can give me a better interest rate. No, they can't. Because they can't loan you their money for the Dream for All portion of the loan. You have to get the big loan and the Dream for All money, the assistance money, from the state of California. And so that's a package deal. It also means it makes it difficult to layer other down payment assistance programs on top of it. Because many down payment assistance programs require a similar bundle situation where you're bundling the assistance money with the main money that you are borrowing. And so that concept says, if I have to bundle both loans with CalHFA and I want to borrow some money from someone else, can I bundle both of those loans again with somebody else? You can't, because there's only one primary mortgage and it has to be bundled with both. It doesn't work that way. So if you're thinking, gosh, I can stack or layer down payment assistance programs, the concept is great. In practice, I haven't been able to do it yet. And the second reason why, the first one is a lot of them require you to bundle the assistance with their big loan. But even if they don't, most require that they're in second lien position. meaning how many loans are on the property and what order are we in. Well, CalHFA requires that they have the big loan, that their Dream for All loan is the second lien. So like, hey, if somebody else wants to loan you money or give you a grant or something else as a third loan on the property, I don't care. But that entity needs to be okay being the third. And more importantly, they need to be okay being the third behind a second, the Dream for All loan, that can grow. Because your Dream for All loan is growing as your equity increases, which means that and I'm not going to go too deep into this, but from a security perspective of their lien and how secure it is, it's actually not very secure because the liens in front of them keep growing. Okay, if you have questions about that, let me know. I can dig deeper into it. But I just want to explain that because that's a question that comes up a lot. All right, let's get back to picking your realtor. So you need to find a realtor, and now is the time to find a realtor. Okay, so step one, you're going to update your paperwork with me. Step two, we're going to have a one-on-one conversation to go over your numbers, and I'm going to update your numbers in my Dream for All calculator portal so that you have your verified numbers, so that you know exactly what we have verified. And now you can run numbers on any property that you're driving down the street looking at with my app, because you know this is the income and this is the debt that John has verified, and this is what my payment would be, and this is what I qualify for. So you're going to do all of that with me. We're going to run those numbers. Then we're going to have a meeting with you and I and your realtor, because we have to work as a team. We have to partner together to strategize, because it's not a matter of, hey, I'm only going to call John once my offer is accepted. There's a lot of strategy that comes into play, and I've got a lot of experience with the Dream for All program, and I've got a lot of experience on how we structure offers, things like should we ask for seller credits or not. We'll talk about things like buying down the rate, doing a permanent or a temporary buy down, and is that a good idea or not? And I'm going to do lots more videos about that in the near future to help you understand all of those choices as you're navigating the waters with your voucher. But you need to pick your realtor. The other thing is you need to understand how your realtor gets paid. Now, I know that you are all first-time home buyers, and some of you might have owned a home before, but for the most part, this is the first time you're going through this process. For many of you, your parents have never gone through the process either, so you may know nothing about the process. But for some of you, you know how it works. And you're going to say, John, I don't pay for the buyer's agent that represents me, the seller does. Well, that changed a couple of years ago. Now, in practice, it's still that way. But in theory, you as the buyer are signing a contract with your realtor. That contract says you as the buyer agree that if you buy any home within the geographic region that's outlined in that contract, within the timeline that's outlined in that contract, then you will pay that realtor a certain percentage of the sales price as their compensation for representing you, even if they're not the one that represented you. In other words, you're buying into this one person. You can't just change your mind. Now, you can ask to get out of the contract, but contractually, you can't and shouldn't be in contract with more than one person. That's the one most important thing I want to point out. The second part is you are technically signing that you're agreeing to pay that amount. So whether it's, X percent, 2, 3, 4, 12%, I can't say a number because that's negotiated. But what I'll tell you is when you pick that percentage, you now have the option, and it's pretty common when you write your offer. In the offer, you check a box, your realtor checks a box that says, hey, Mr. Seller, I want you to pay the buyer's realtor this commission percentage that I've already agreed to pay them, and you make that part of your offer. And if they accept, then, hey, I agreed to pay you X percentage, Mr. Realtor, but I passed along that obligation to the seller, and they're going to pay it instead, and you owe your realtor nothing. But the seller can disagree. The seller can counter offer and say, nope, I'm not paying any of your agent's compensation, or nope, I'm not paying that much. I'll pay a lower amount. If that happens, then you've got to go back to your realtor. Contractually, you owe them the difference. Sometimes you can negotiate with your realtor depending upon how far off they are, but that's a conversation you have to have with your realtor. So right now, you have to decide, who do I want to use as my realtor? If you need a recommendation, I have agents that I know up and down the state, and I likely have somebody in your region that I can connect you to that I think would do a great job for you. But the bottom line is you need to pick an agent, and then you're going to sign a contract with that agent, and you're going to have them represent you through this transaction. So that's everything I want to talk about with realtors. Again, we're going to have a meeting. Once we do our meeting, then we're going to do a meeting with the realtor and you and I in order to set up our strategy on this. All right. So the type of home matters. And this is a big question that I get. So obviously single family homes are great. Duplexes, triplexes, fourplexes are not. CalHFA does not allow those homes. Now you can do a single family home with an ADU, but you can't count rental income from that ADU. You can do condos, but the condo has to meet the requirements of Fannie Mae. And that's actually a pretty big problem because Fannie Mae, who's the government entity that backs a lot of mortgages, and CalHFA has determined Fannie Mae's guidelines is who they're going to use. Fannie Mae sets the rules to say, hey, under what criteria will we do this loan? And they're qualifying you based on your credit, your income, and your cash. But when you're in there, they're looking at the property to say, hey, is any property that you're buying livable with no health or safety hazards? Then the property is fine. And is the property worth the amount of money that you're paying for it? In other words, are you the only one willing to pay that? Or are there other people willing to pay a similar amount? That's the value consideration. But on condos, there's one more thing, which is the financial and physical health of the condominium association and the actual project itself, which extends beyond just your units. So if you have one of the biggest things that created problems in the last 2 years is in California, there was a Senate bill passed in 2019 that said by the end of 2023, every condominium project had to have their balconies and staircases inspected by engineers to see that they are structurally sound. Well, a lot of them got the inspection done, some didn't. A lot of them got the inspection done, but didn't do the work. And it might not have been a problem with your individual unit, but it's a problem with the project. And you'd say, John, I don't have a balcony. I'm on the ground floor. There are no stairs. Yeah, but there's a cost to fixing and upgrading the entire project. That cost, by the nature of condominiums, is spread across the entire project. Which means if it's $100,000 of work and there are 10 condominium owners in there, 10 units, then it's $10,000 per unit. Even if the work only has to be done on one building, let's say it's a roof that has to get repaired, okay? A roof is only on one building. Maybe the other one, the roof is fine. There's 2 buildings, there's 5 units each in those 2 buildings. But it's $100,000 to repair the roof in that building. They're going to spread it out over all 10 owners. It's not about your unit and what's needed in yours. All the cost from the HOA is spread out over everybody in the HOA. And so the rules that come from Fannie Mae say, look, we have to make sure that the condominium association doesn't have any large pending, large pending expenses that they haven't set aside reserves for. They want to make sure that their owners are paying their dues on time and that they don't have a bunch of people who are delinquent. They want to make sure that there aren't any health or safety or structural issues with the project. And so there can be major issues with condominiums. I've had many buyers who have been unsuccessful in buying condominiums in the last couple of years. I've had many who have been successful. So I'm not talking you out of it. I'm simply saying it's more difficult than you would think. Now, townhomes are different from a condominium. A lot of times there's confusion, and even a realtor online will say this is a condo when it's really a townhome. Townhomes are way easier. We don't care about the HOA, even if there is one, because each townhome can live on its own. There's nothing above it or below it anywhere in the project, and therefore, if the HOA goes belly up, who cares? Because your unit is freestanding, and you don't have to worry about the HOA maintaining the roof over the 2 units above you plus you, because you only have a roof over you. So there's a difference there. It's a nuance, but it's a very, very important difference. And we can do manufactured homes as long as it is on land that you own. You cannot do a manufactured home in a park, but you can do manufactured homes on land that you own. Dream for All does allow that. All right. New construction is a whole nother thing. So new construction, you've got The builder wants you to use their lender. You don't have to, but they give you strong financial incentives to do so. But a lot of buyers using Dream for All that bought new construction. And the builders are pushing hard for you to use their lender because the builder is worried that what if something is going wrong partway through the transaction? That lender, is he going to tell me the truth? Well, if you're working with me, I have no obligation to tell them the truth. I'm not going to lie, but I'm not going to volunteer information. But the lender that is affiliated with the builder, they have an obligation to tell them early because they're going to get fired if they don't. They can't fire me. So the builder will actually give you large amounts of credits in some cases to use their lender. As long as their lender can do Dream for All, you're fine. You can use their lender, you can get the Dream for All money, and you can get the seller credit. That's great. I will happily tell you, do not use me. I believe I am the best out there, but I am not worth $15,000 of closing cost credits to use me. Now, if they're offering you $2 or $3 grand, maybe I'm worth that. Okay. But the fact is that I will tell you, don't use me, use them. And when you time to refinance, when your friends and family want to get a loan in the future, come back to me. And remember, I'm here to make sure that you're getting the best possible deal, including telling you not to work with me. So here's the catch-22. The catch-22 is the builders also sometimes offer subsidized interest rates. They say, hey, if you get your loan through our builder, through our lender, we will offer you a 30-year fixed rate at 4%. That's awesome, and that's very real. But it's only if you use their lender's pool of money. And Calhafa says you have to use our pool of money, and therefore you can't get the low interest rate that the builder's offering because that's using the builder's money for the mortgage. Calhafa says, no. To use our Dream for All money, you have to use our money for the mortgage. And Calhafa is not subsidizing or providing that super low interest rate. The final thing I'll tell you is there are some circumstances. I was successful 2 or 3 times in the last 2 years of getting builders to give the lender credit for their preferred in-house lender, even though they used me. The number one reason why for 2 out of the 3 was because their lender wasn't affiliated with Cal HFA and couldn't do Dream for All. And then the final one was just a home where it was the last home for sale in the subdivision. The builder was trying to get out of there, and the buyer really wanted to use me, and the builder wanted to be done. And so the builder just said, you know what? That's fine. I don't care. We just want to get it sold. Use John. We'll let you proceed in this transaction, no problem. So be aware of some negotiating power that you have there. The other thing that I will tell you is many builders don't cooperate or pay your realtor. So if you have a realtor that you signed an agreement with and you start looking at new construction homes, talk to your realtor about that. Sometimes the builder requires your realtor was the one that brought you to the builder the first time, and then they'll pay for your realtor. Sometimes they won't pay for your realtor no matter what, and you need to be aware of that and have that conversation with your real estate agent. So new construction can be done, but it is a different beast. And talk to me about that if you end up going that direction. All right, so let's talk about how to use the money. There's 3 ways to use the money, and you can be anywhere in between here, but this is the simplest way for you to understand how to use the money. The common option that most lenders talk about is option number 2, which is, hey, you're buying a $500,000 home. You get $100,000 from Dream for All. Therefore, you're going to pay you have a loan amount of $400,000 as your big loan. You're going to have a $100,000 second from Cal HFA. And so it's called an 80-20. 80% of the purchase price in the big loan, 20% of the purchase price in the small loan, but you have closing costs. Now, closing costs, generally speaking, on non-Dream for All loans, run around 3% of your purchase price for closing costs. Dream for All is more expensive. Dream for All, you're going to run closer to 4% plus or minus. Could be a little above, could be a little below, but 4% is the target number that I use for budgeting to say, hey, closing costs are going to be 4% of your purchase price when you are doing a Dream for All loan. The reason for that is simple, because mortgage companies make money 2 ways: upfront fee or interest over the life of the loan. Well, when we're doing a Dream for All loan, we are only making the upfront fee because CalHFA is partnering with the servicer and they're making the income on the interest over the life of the loan. And so mortgage companies have to charge more in upfront fee. Now that 4% includes everything except for inspections and appraisal and credit report. But that upfront fee, or that 4%, excuse me, includes the lender's fees. It includes the title and escrow fees. It includes your first year's homeowner's insurance. It includes property taxes. All of that is in that 4%. Okay. All right. Sean's got a question. Hey, Sean, how are you? All right. So Sean says, we are pre-approved and told we could add an additional 5% down payment. Can we add more than 5%? If yes, is there an upper limit? If not, what's the determining factor for only 5%? Well, Sean, what you're asking about is option number 3. So option number 3, and the determining factor is the state. Okay. I don't know that this is true, but I think one of my conversations with Cal HFA pointed this out. Like when the first version of, or I learned this, I should say, through a conversation I had with Cal HFA. The first version that came out in 2023 said you could put as much as an extra 20% of your own money out of pocket. And therefore, you would do a 60% first mortgage, 20% from Cal HFA. Actually, you could put as much as 30% out of your own pocket. You could borrow 50% as your first mortgage, 20% from Cal HFA, and you put 30% as a down payment. And the state thought, you know what? Those people had 30% of their own money. They really didn't need our 20%. We need to save this money for people who truly have a need. And this is how they are coming up with that. They're basically saying, hey, if you have more than 5% of your own money to put down, that's okay. But if you want to use it, then use your money and not ours. You can have millions of dollars in your bank account. We don't care. Okay, some down payment assistance programs say you're not allowed to have extra money left over. But CalHFA says, we don't care. We're not forcing you to use it. But if you want to use more of your money than 5% of the purchase price, then you can buy without our help. Now, I know that's not that simple because there are people who are saying, hey, in the region that I live in, home prices are here. And with 20% in help, that only gets me to here. And that price is still too high of a monthly payment. I need to get my loan amount down here. And so I need to add extra money. I can't afford to come up with a big enough down payment on my own. And I can't afford the payment with just a 20% plus my 5. I get it, Sean, but that's the rules the state came up with. And so it's very, very simple. Option 3 says you are paying, that you get the 20% from the Dream for All plus up to 5% of the purchase price from your pocket. And then you also pay the closing costs. So you're paying about 9% of the purchase price, 5% down towards the actual purchase price, 4% towards closing costs. You're coming up with 9% out of pocket. Now, technically, you can also buy down the interest rate. You can buy down the interest rate permanently to get a lower interest rate. I'm going to do another video down the road explaining to you how we buy down interest rates and the pros and cons of doing that. But technically, you can put more of your money to buy down the rate, and that gives you a pretty darn good bang for your buck on getting a lower monthly payment. The problem is there's a limit to how much you can buy down your interest rate from your own money. So now we start playing other tricks, which is we ask the seller to credit you money towards your closing costs. Now, I actually think in most cases, getting a seller credit for closing costs on Dream for All is counterproductive, except in this case, which is, hey, I'm trying to get the lowest possible monthly payment. I'm already putting the 5% extra out of my pocket. I'm already paying as much as I can. There's a state limit on how much you can spend towards buying down your rate. But the seller's money doesn't count towards that state limit of how much you can spend buying down your rate. And you're allowed to get up to 3% of the purchase price from the seller for closing costs. So the ultimate strategy is we actually negotiate with the seller to raise the price so that we can build in extra money into the purchase price that is then credited back to you in closing costs that you can use to buy down your interest rate. And that gives you strategically the absolute lowest monthly payment when we're looking at option number 3. So there's a lot of strategy here. There's a lot of case-by-case situations, so don't take what I'm saying and, okay, John, I'm going to tell my realtor what you said on that video. This is why I do a conversation with you first about finances, and then a joint conversation with you and your realtor about strategy on writing the offer. And then I'm involved as you write the offers and send them to the realtor for the listing agent, that I get copied on every one of those offers so that I can call the listing agent and explain to them why we're doing what we're doing and explain to them how solid this offer is, how we've already gotten your file, not just pre-approved, but fully underwritten. Now it takes a couple weeks to get full underwriting approval, so it's not going to be immediate. If you write an offer right away, you can do that, but it won't be fully underwritten at that point. And so I am involved in every step of the way to help navigate those waters. But Sean, it's a great question. And you cannot add more than the 5%. It is a statutory rule from Cal HFA for this program. Okay. All right. So that's option number 3 that I was just talking about with Sean. So now what's option number 1? Option number 1 is actually the most common option that I have had for all. I've done 60 Dream for All loans between the 2023 money and the 2024 money. And more often than not, people went with option number 1, which is often zero money out of pocket. Okay. Where it has to be some money out of pocket is if you're buying a house more than $750,000, because the state will only give you up to 150 grand. Capped at 20% of your purchase price. If you're at 750, 20% is $150,000. If you buy $1 million home, okay, you can buy $1 million home, but what you're looking at is you're looking at $150,000 from the state, and you say, John, I want option number 1. I don't want to pay any closing costs. No problem. So then we take the closing costs out of that $150,000 from the state. But here's the deal. When you do that, you're no longer putting 20% down. Now, the fact is, if you're over a $750,000 purchase price, you're also no longer putting 20% down unless you put extra of your own money. Whenever you're putting less than 20% down, the easier way and the more accurate way to say that is when your first mortgage is greater than 80% of the purchase price. That's actually the right way to say it. Then you have to pay mortgage insurance. So when I'm financing in the closing costs, that means that your loan amount is bigger than 80% of the purchase price. That means you have to pay mortgage insurance. Now, historically, what I've done, instead of charging you a monthly fee for mortgage insurance, we build it in as a one-time fee. That one-time fee is anywhere from 0.5% to 1% of the purchase price. So from my math on my app, you're going to notice that I make the closing costs 5% of the purchase price as a simple average when you're using option number 1. So when you want to finance in your closing costs, the closing costs go from 4% to 5%. That is not a factual number. None of my closing cost numbers are factual, but I've done this a lot, and it's a really, really, really good ballpark. So option number 1 means you're borrowing ultimately more than the home is worth. I'm going to use the $500,000 purchase price as an example that I used earlier. You buy a $500,000 home. The state is going to loan you $100,000 in the Dream for All loan. Now, if you do option number 2, it means your first mortgage is $400,000. And then the state's $100,000. You are then paying, so that's 100% of the purchase price. You're then paying the closing costs out of your pocket, and those closing costs are 4%. My app goes through all of this, so you don't have to memorize these numbers, but I want you to understand the concept, okay? So that means you're coming up with 4% of $500,000 or $20,000 in closing costs. And you're like, John, I don't want to pay that $20,000. I want to pay nothing out of pocket. Great, then you're going option number 1. So with option number 1, now your $100,000, $25,000 of that is going towards closing costs. Remember, the closing costs got a little higher because of the mortgage insurance. So $25,000 goes towards closing costs. Now you're borrowing $425,000 on the first mortgage and $100,000 on the second. Your total loans against the property are $525,000 on a home you just bought for $500,000. You're already underwater. Now, in the long run, home prices will come up and you'll be no longer underwater. But starting out, you are underwater. You owe more on the house than what it is worth. Now, that on the surface is a horrible thing, but so is Dream for All. Like on the surface, Dream for All is a horrible thing because you have to pay back 20% of your appreciation down the road. But the truth is it gets you into a home. And so you are better off doing option 3. If you have the money to come up with extra money, option 3 is for sure the best choice. Option 2 is the next best option. But for a lot of people, option 1 is the only way they're getting into a house. And now you're getting the rest of the benefits of the home ownership. There's financial benefits when you have the fact that you're getting tax deductions, you're building equity every single month when you pay down your mortgage payment, and you're getting the benefit of long-term property values increasing. So all of that to say, you have to decide which of these 3 options you want, but these are the parameters. Okay, the 2 bookends, most out of pocket is 5% plus closing costs. Least out of pocket, we can finance in the closing costs, and I can even finance in the closing costs on a home that's over $1 million. So people misunderstand are like, oh, it can't happen because it's too high. No, we can do it. So I'll show you the math. It's in my calculator. You need to run your numbers using my app. And let's dive in really quickly and give you an example of what those numbers look like. Okay. So right here, this is the app. If you don't have it already, you've got the link up above and you can start using the app right away. The link up above takes you to a shortened version that just kind of runs basic numbers, and then click the button to log in and create an account. You'll put in your income, you'll put in your assets, you will put in all of the money that you owe in, not assets, you put in your income, you put in your credit score, and you put in your debts. And then it will tell you how much you qualify for. It will give you what your maximum allowable monthly payment is, and then it'll run the numbers for you. And so you can say, hey, I want a specific payment. I want to buy a house with a $6,500 payment. And rates aren't at 6.125. This will update every single day. Yesterday, I believe they were at 6.625. I just was playing with this earlier. So a $6,500 payment at 6.625 says, okay, then you're looking at a $934,000 purchase price if you want the lowest cash to close. You need about 10 grand. If you're looking at you paying the closing costs only, you're looking at 53 grand. And by the way, you had said right here, you only had about 40. So it says, hey, it exceeds your cash. Oh, no, I can get more money from grandma. So I actually have $75,000 I can use. Cool. Then you're good, but you're not good on this option because this option requires 106. Now, maybe you can come up with more money, but I've programmed this to kind of look at telling you, hey, by the way, you told me you need this. Same thing if you say, hey, I want a specific purchase price. I want to buy a house at $1.2 million. That's what I want. And it's going to say, awesome, here's your math. But bro, you're not qualified. So I'm going to give you the math, but then I'm going to tell you, time out, you're not qualified. This is beautiful as you're out shopping for homes. Once I update your assets, I update your income, I update your credits, I will create a calculation in here with the amount of income that we are using for you, your debts that we're using for you, and then you'll be able to look at this as a verified amount that you qualify for. Okay. Why does that matter? Because now you can confidently run numbers as you're driving around looking at houses. You're saying, hey, how much is this house going to cost me? Well, I don't know, honey. Grab John's app and let's take a look. That house is $985,000. Awesome. Well, that house is $6,500 if we come up with $54,000. Ooh, but you know what? It's not that much more money. Let's go with this with only the 10 grand out of pocket, because then we can use that extra 45,000 to do remodeling on the home. I'd rather do that, honey. That'll make the house price worth more because we did that remodeling. These are the things that you can do from your phone, in your car, as you're walking through a home and knowing, oh, wait, this one has a homeowners association. So you're going to add the homeowners association of $850 a month. And what does that mean? Ooh, it means we're no longer qualified for the zero cash to close option. See how this all plays together. So I've built this with you in mind. As you are out shopping for homes, you're going to ask questions every time. Well, wait a second. This house has higher property taxes than the other one. So what is that going to mean in a monthly payment? Well, the builder said this one's going to have 1.75% property taxes, and it's only going to have a $250 HOA. Cool. Then here's your numbers with 1.75 property taxes and a $250 HOA, and then you can save it. And you can say, hey, I want to save this one as the 123 Main Street property. And now you can save that. You can email it to yourself. You can just save it to my portal. So basically, it allows you to run all of your scenarios and be able to capture, hey, well, we're looking at these 3 homes this weekend. Let's run the numbers side by side on each of the 3 homes and email us those scenarios so that we can study them and decide which one's worth which dollar amount and which one do we qualify for and which one do we not qualify for. So this is powerful for you to be able to use as you're out shopping for a home. All right, let's get back to hopefully wrap up in about the next 10 minutes. Let's talk about what's left. The money you need out of pocket. So remember, guys, you have questions and you're watching live, post the questions now. If you're watching recorded, post those questions later. I'll get back to them. What money do you need out of pocket? So the first thing you need is your earnest money. Earnest money is not a fee. It's a deposit. And you can get the deposit back in full. If you go the 0 out of pocket option and you have no money due, you get the earnest money deposit back. So it's not an extra fee. What it is it is the money that you're giving the title company that the seller sees as part of how serious or committed you are to buying this home. Because technically, if you back out of buying the home without a valid excuse, and there are 4 valid excuses: loan contingency, appraisal contingency, inspection contingency, or insurance contingency. Those are your 4 valid excuses. And you have timelines on those excuses called contingencies when you write your offer. Now, if we have a fully underwritten pre-approval, maybe we're going to ignore or not ask for a loan contingency because that makes your offer look better. The shorter your contingencies or the fewer your contingencies, the more the seller is going to like your offer. But it also depends on how badly do you need the seller versus the seller needs you. If the house just came on the market and there's 100 people writing offers, then you need to do everything you can to make your offer look better. If that house has been on the market for 6 months and nobody's writing offers, you're kind of in control. And so that's really how you have to trust your realtor on understanding the market and understanding each individual home and what its circumstances are on how you write your terms of your offer. Earnest money is simply one of the terms of the offer. You need to listen to your realtor. If you write too small of an earnest money deposit, a seller won't take you seriously. Legally, it needs to be at least $1. But if you write an earnest money deposit at $1, some sellers are going to say, forget it. I mean, you're playing games with me now. And if you're playing these games now, then what other games are you going to play later on in the transaction? No, thank you. So listen to your realtor on the strategy of earnest money deposit. So you're going to pay an earnest money deposit once you're in contract. You're going to pay appraisal and credit report fees, which are going to be $600 to $850 on average. And then you're going to pay for inspection fees. Those are roof inspection, home inspection, foundation if necessary, chimney inspection. There's 100 different inspections that you can do. Most people simply do a home inspection and use that as a starting point. Unless you see something else that's an issue, the home inspection is kind of like your general practice doctor doing an annual checkup or physical. They're just looking at everything. Then they're going to say, hey, that thing, I want you to go see a dermatologist about that thing I see. And also about your knee, I want you to go see an orthopedic about that. So the general practice doctor is doing a full overview and then telling you what specialists you should go see. That's kind of how it works in real estate. Unless you know there's a problem and you want to go straight to the dermatologist, you say, hey, I want a home inspection. And then the home inspector will say, hey, I'm a little nervous about that roof, but I'm not a licensed roof inspector, so go get a roof inspection. That's typically how it works. These fees that you are paying for appraisal, credit report, well, not credit report per se, but appraisal, we're appraising that property. Once the appraiser did his job, you don't get the money back just because you don't buy. Same thing with inspection fees. The inspector went out and inspected that property. He did his job. You don't get the money back if you don't buy. Okay. Now, what if you don't find a home in time? First of all, Cal HFA last time offered 90-day extensions to everyone who had a voucher. I expect they're going to do the same. The process last time was on day number 60, when you had 30 days left on your voucher, a little window popped up or a button popped up that said, request an extension. When you request it, the next day you get a new voucher. Your old voucher is now null and void. You get a new voucher that shows a new expiration date 90 days after the original expiration date. So you do not have to wait until the 90th day to request it. Some people thought that was the case, but no, if you do it on day number 60 and you still have 30 days left, then your new voucher isn't 90 days from then, it's 90 days from the current expiration date, you get the full amount of time no matter what. So as soon as you see that button that says request an extension, request an extension. But I suggest you start shopping immediately. I don't want you to buy a home that doesn't make sense for you, but don't be too picky, because there will never be the perfect home. You can always do work on it later. There's certain things you can change and certain things you can't. It's the joke in real estate about its location, location, location. Why? Because you can't move the house. Once you're there, that's it. You can change anything else about the house, but you can't physically move what city it's in. You can't move your commute to work. You can change your work location, I guess. You can't change the neighborhood or your neighbors or any of that stuff. So just be aware of what you will, what is non-negotiable versus what you're willing to compromise on. That's an important thing to understand. By the way, what happens if you find a problem during inspections? You should negotiate with the seller first and foremost. The seller wants to sell the home. And the truth is, once the seller's in contract, they've mentally already sold the home. And so at that point, like when you're getting into contract and you're saying, hey, I want you to give me all of this money as concessions. Well, no, I mean, I'll wait for a better buyer. But as soon as you're in contract, they've got a buyer, they've moved on. And so now if you negotiate with them, the likelihood of them conceding, giving concessions and saying, fine, you're right, I'll do it, because they don't want to start over and put it back on the market. They don't want people coming back and having to host open houses and keep the house clean every single day so that somebody can pop in. It's a stressful thing to sell a home. And so you need to be aware of that and not worry too much about requesting additional negotiation or requesting additional concessions from the seller. But here's the truth. Worst case, cancel and start over. As long as when you cancel, you recognize your expiration date on your voucher didn't change. So if you're in contract now and the house doesn't work out early, no big deal. You get a new voucher issue. Once we cancel it, that voucher has the same original expiration date. But if you get into contract on the day before your voucher expires, and now a week later you find out there's a problem, if you cancel, by the time they go to reissue a voucher, there's no more time left on your voucher. You don't get a new voucher. You must be in contract by the day that your voucher expires. And I have to register you in CalHFA's system by midnight that night. There were 2 clients that I registered literally at 9:30 at night over the last couple of years because they got into contract the day their voucher expired. They were fighting hard to make it happen, and they did, and they successfully got their home. So I know how to navigate these waters. Sean asks, are these extensions always granted, or are there requirements? There has never been a requirement yet. So it has been offered to everyone with a voucher, and there was no explanation required. There was no case-by-case circumstances. There was no rejections of requests. Everybody got their extension granted. I expect they're going to do exactly the same thing this time. Obviously, none of this was in writing, and so I can't promise you that, but I have every expectation that it is going to be exactly that way. All right. What else do I have? Foreclosures and short sales. We'll wrap up with this, and then any questions you guys have, post them now or forever hold your peace. Can I buy a foreclosure? Yes, if it's listed in the MLS. In other words, if it's listed in the open market, then you will have time to, Bobby, I'll get to your question in a second. You will have time to get your lending in order. You'll have time to write, to get an appraisal done, et cetera. It's just a normal transaction. It's just the bank has foreclosed and owns the property. What you can't do is you can't go to an auction at the courthouse steps. Those require cash. That's also a foreclosure, but those require cash in order to buy the home. You can't do that. Short sales is a whole nother thing. Short sales, I will tell you, stay the heck away from short sales. And prices have dropped nationally about 8.5% over the last 3 years. So there are some people who are doing short sales right now. A short sale means they're selling the house for less than what they owe. Well, that means there's no equity left for the seller. The person who's losing money is the bank. There's no money to be made for the seller, but the money that's to be lost, is the bank's money. And so what you're looking at on a short sale is a situation where the decision maker is not involved until halfway through the escrow period, because the bank is the decision maker that decides, hey, am I willing to accept this price, or do I think I can get more? In other words, lose less if I foreclose it and sell it myself. So a seller on a short sale will often list the price super low. simply to get a buyer in escrow. And so you're going to say, oh my gosh, John, there was a $600,000 home that was selling for 500 grand. Like everything else like it is selling for 600. This one is selling for 500 grand. And I got my offer accepted by the seller who doesn't have decision-making authority. The decision-making authority comes from the bank that looks at it about a month to 2 months later. And the bank says, sometimes it's faster, but sometimes it can be even slower. The bank says, yeah, no, 500,000 is way too low. The least I'm going to accept on this thing is $575,000. And the seller's happy because now they know the number. Now they can go out and actually get that number, but they don't know what the number was until then. Now you have the first right of refusal because you're in contract. You can raise your price to 575, but you're like, wait, I don't qualify for that. That's not fair. I was in escrow at 500. You accepted my offer at 500. That's the most I qualify for. And now you're telling me I have to pay 575. Because the seller didn't have the authority to actually determine that that was an acceptable price. They needed the bank to tell them that. So now the seller's happy, you're sad. And if it took too long, you're out of time with your voucher. That's what I'm worried about. Now, some short sales go through just fine. Sometimes on a short sale, the price is only a little bit higher when the bank comes back and you can cover the difference, meaning we can raise your pre-approval amount. There's lots of situations. But I've seen people have short sales that take longer than 6 months. There is nothing short about a short sale. Okay. The term short sale means that the bank is being shorted. They're not being paid the full amount that they are due. And so there's a huge risk when you're looking at a short sale. All right. So Bobby asked, what does it mean when I say be aggressive in writing offers? So Bobby, I'm going to do a whole video about how to get your offer accepted. Matter of fact, I feel like I did one recently. But anyway, I'm going to tell you right now. Your aggressive means that you are writing offers. God, there's lots of ways. How you structure the terms. So when you say, hey, I want to get a deal on this house, and so I'm gonna lowball it. Well, that's not really aggressive. Okay, aggressive is, hey, I think this house is listed a little bit high, but it's a great house, and I'm willing, and I really don't want to lose out on the opportunity, so I'm going to go ahead and pay full price. Being aggressive means thinking about what the seller wants and giving them that +1. That doesn't mean screwing yourself in the long run, but it does mean creating a win-win situation. I was just on the phone yesterday with a real estate agent and their buyer having a conversation about strategy on an offer that they were writing. And I had said, hey, I suggest we offer the full price to the seller and then ask for a closing cost credits. We'll use that to buy down the interest rate to give you a better deal instead of asking for a lower price. And my reason for that was I wanted them to be aggressive in writing the offer because sellers often think emotionally and not logically. If I said I'm going to give you $500,000 for your home that you have listed for $500,000, and I ask you for $30,000 in closing costs, versus if I say, hey, I'm going to give you $470,000 for your house. The financial math is the same, but to a seller, they're getting full price. They're not getting full price in the end, but they're selling it for full price. They get to tell their friends they sold it for full price. They get to feel good about their price and that their house was worth everything they told them to pay. Well, closing costs are closing costs. That's normal. In their mind, they can justify it. Okay. What the buyer wanted to do is the buyer wanted to offer a little bit lower price and ask for a closing cost credit. So that's like saying, hey, I'm going to offer you $490 and I want $20,000 towards my closing costs. Remember, guys, all three of those scenarios give the seller $470 at the end. $500 with a $30,000 credit, $470 as a price, or $490 with a $20,000 credit. No matter how you look at it, all three of those give the seller the same price. But the seller's going to feel the worst about option number 3, where you're lowering the price and asking for closing costs. I tell you, it's human nature. It's emotion. They're going to feel like, how dare they offer me a lowball price and then they expect me to pay their closing costs? No. Out of principle, the answer is no. That's how people think. And so it's a psychological thing. And I've studied this and I've done a lot of transactions. It's about how the seller is thinking. And so you need to think about that. It's not about, well, here's what I want. What you want is the home. If it's the right home and I can get you the right payment with the right cash out of pocket, Who cares how you structured the offer to the seller? That's where you're aggressive in how you write the offer. Maybe you're writing the offer aggressively. At the house I'm sitting in right now, I wrote the offer on this in 2021 in the height of the market, and I wrote an offer super aggressive. We went and saw the house on a Saturday morning. We knew that we wanted this house. We knew that they were having another open house on Sunday, and my realtor called the listing agent and said, "Hey, is your buyer going to look at offers? When's your buyer looking at offers?" And the listing agent said, "Monday, because we've got people coming up." As a matter of fact, it was a holiday weekend like this. And so he said Tuesday. He said, "We've got an open house on Sunday, and then we've got other people coming up to look at the property on Monday. And so we want to have all those people come through the property before we look at offers on Tuesday." I didn't want that. I wanted the house, and I didn't want anybody else to come see it. And so we wrote our offer with a deadline of 5. We wrote our offer at noon on Saturday, and we gave a deadline of 5 p.m. Saturday night to respond to the offer. And the listing agent got mad and called my agent and said, "How dare you? I told you we're not looking at offers until Monday or Tuesday." And my agent said, "I understand, but that's what my buyer instructed me to do." Now, technically, you might not know that was the instruction, but that's what your realtor will say is, "Look, that's what my buyer instructed me to do." Even if your realtor had the idea, that's how they save face. "That's what my buyer instructed me to do." And guess what, Mr. Listing Agent? You have an obligation to tell your seller. Well, guess what? The listing agent went to the seller, and the seller accepted our offer. Do you know why? We found out later because we ran into the seller during an inspection, and he said, "You know what? We didn't want to have to leave the house on Sunday. We didn't want to have to leave the house on Sunday. They didn't want to do the open house. We gave them full price. We actually wrote an offer a little bit over asking price. So this is what I mean by being aggressive. This was 2021, okay? But full price, over asking price, no loan contingency. But I gave them, so I made the offer look really, 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 really strong. And then I gave them a short amount of time to say yes. It could have backfired. They could have said, "No, screw you. I'm waiting until Tuesday. I think I'm going to get better offers." They probably would have gotten better offers, higher offers. But I won from a strategic option that I chose, a path. Could have backfired, but I won. That's what I mean by being aggressive. It isn't just about, let's write the offer at whatever. No. Let's think strategically. Maybe the seller has to sell their home to buy another one, and they need extra time to move out of their house. Maybe you offer to let them stay in the house for 30 days for free. So you're now, and you got to say, "Well, John, why am I going to pay for that?" Well, your first mortgage payment isn't until 30 to 60 days after you bought the house. It really doesn't cost you anything. But there's strategy there that says, how do I create a win-win for me and the seller? And how can I be aggressive to make my offer look the best if you are the only person there writing offers, you don't have to be very aggressive. But when you have a lot of other people that you're competing with, it's important that you're being aggressive, or you're just pretending. You're just writing offers. You're not actually trying to buy a home. Bobby, I hope that makes sense. And let's dive back to where I want to wrap up. Let's go here. Great questions, by the way. All right. Quick reminder. We're going to wrap up here in a second. I said it earlier. My company merged in April, and we are March, April. We're now at Cross Country Mortgage, same team, everything's the same. But the portal, if you used my app to get pre-approved back in February or March, that app is gone. It's closed. Summit Funding doesn't exist anymore. And so you need to work through our new portal. The steps for you right now is you need to send me your voucher. If you haven't already, download your voucher and send it to me as number one. Number two, put my info, my email into the CalHFA portal so that I automatically get any updated vouchers, because there's a spot there for your lender's email. So those are the two steps that you need to take right now. Use the app to run your numbers. So app.californiadreamforall.info to run your numbers. If you haven't created an account already, you need to do that now. If you have, once we meet, I'll update the account with your verified pre-approved numbers, and that way you'll know for sure what you qualify for. And a reminder of your next steps as we finish up: do the home buyer education for both educations. Okay, send me your voucher, and then we're going to schedule a one-on-one meeting after you get me your income documents. So once you send the voucher, I kind of skipped this step. You're in writing. My team is, once you send me your voucher and tell me, "Hey, John, I've got a voucher," we're going to copy your information from what we had previously at Summit. If you did not apply with us before, we're going to send you a link for you to complete the application. Either way, we're then going to send you a link to upload your updated pay stubs and bank statements. Once we've got all of that, we're going to schedule a one-on-one meeting for you and I to talk strategy, to talk about purchase price and loan amount and monthly payment and option A, B, or C. And then we're going to schedule a meeting to have with you, me, and your realtor after that. If you're not already working with me, you can go to ccm.com/John-King to get started with the application. And don't forget, it's time to start finding your realtor right away. Guys, that is everything I wanted to cover. Thank you for trusting me. If you're not already working with me, I am interviewing for the job of being your lender. I've successfully helped a bunch of people. You already got a pre-approval letter from another lender, but you're here listening to me. You're not obligated to use the lender that gave you the original pre-approval letter. You get to choose who you want to use. Remember, the rate is the same. CalHFA charges the same interest rates. You're looking at maybe a little bit of difference in fee from one lender to another. I think we're pretty competitive and aggressive in a lot of cases as far as our fees are concerned. But even if I'm a little bit more expensive than somebody else, I think I'm worth every penny. And hopefully the knowledge I've been giving you has proven that. And I am for sure interviewing for the job and asking you for the opportunity to be your lender. Guys, I really appreciate you listening. Sean says, thanks, great info. You're very welcome, Sean. Look forward to talking to you very soon. Everybody have a wonderful weekend. Enjoy the holiday weekend, and we'll talk to you soon. Bye-bye.